We've been trying to figure out what's going to happen between now and Christmas. And one of the things beyond the debate about the Fed, which is obviously the biggest piece of this, that I do want to get to with you is tax harvesting, which is we get to the end of the year and there's a lot of movement and a lot of weird things can happen. But why don't we go first to where you think the economy is and therefore where you think the Fed is and therefore where you think the stock market is.
All right, let's do it. Look, I think from the Fed standpoint is this takes time to slow down. I mean, raising rates, lowering rates, anytime you do something in a quick fashion, it takes a lot of time for it to kick in. And I think we're seeing that now. It will matter a lot what happens with retail sales. We're very keenly focused on the next 2-3 weeks. I think people still have money to spend, but we will be very focused on what happens there. Lastly, you're seeing so much volatility in the markets, and that's part of the concern for us going into year end. And what's the most important is bonds and stocks fell at the same time this year. So people had a lot of opportunity to sell tax harvesting throughout the whole year. I don't think you're going to see real tax harvesting at the end of the year.
So when you think, though, about putting money to work, given where we are right now, do you think the move's already been made? And what do you think happens if we have this conversation a year from now in 23? Where is the equity market?
I think a year from now, it's much higher. I mean, anytime you have such bad consumer sentiment, which we've had probably for the last 3, 4, 5 months, the markets are higher on average on the 4 or 5 worst consumer sentiment days. The markets are higher on average by 20 to 25%. So I think a year from now, if your portfolios are positioned in a way that you have a plan, you're sticking to it, you're focused on earnings, you're focused on active management and diversification. When you include stocks and bonds, there's also a major piece for alternative investments, which this year have been extremely important. And, if you have an alternative investment allocation, 25, 30% of a portfolio, it limits volatility in down markets and also helps in up markets. So I just think we're in a position now where the Fed has inflation under control. That's going to start kicking in if it already hasn't. We're seeing the Fed talk about not raising rates as fast anymore. And so I think you'll see that really kick in the first or second quarter of next year.
So what do you think when you read, for example, Goldman Sachs just out last week with a report suggesting next year's basically be flat, maybe up 1%?
They're obviously Goldman has a lot of smart analysts and people are doing a lot of work right now on trying to figure out what the future looks like. But I think what we try to do is just really focus on allocation, really focus on positioning with strong managers who, we've seen over time could outperform the markets. And I believe right now the Fed is really getting this under control. I believe sentiment's going to start getting better. You're also going to have the election overhang is pretty much past us for at least 2 years now. And so geopolitically, a lot of things are falling into place that are going to create less volatility. But, I just think looking at earnings, looking at the future, looking at what the Fed has done and continuing to monitor portfolios, we're confident in what the future looks like for the equity markets. But the most important component, too, is the fixed income markets. I mean, when was the last time we saw volatility like this in fixed income? But it's sort of calming too, as you see, I just saw you put up a chart to get a 2-year Treasury 4 and change. That's a 4% return next year on the fixed income markets if you were to do that today. So, right. I think the worst is behind us. Is what we're looking at.